Alright, so welcome to part 2 of this video. Bank stocks, they look cheap, but are they safe enough to buy? So in this second part of the video, I'll be running through how to look at ratios to ensure that you only buy the safest bank stocks. And I'll show you as well which bank stocks I'm looking at, both in the US and Singapore markets, and where I think they'll be cheap enough to buy at. So stick all the way to the end to find out what I'm going to buy really soon. The first ratio is called Common Equity Tier 1 ratio. This is calculated by taking the company or the bank's Tier 1 capital, which is its core equity capital, the common stock and retained earnings, and dividing it by the total risk-weighted assets of the bank. Now, don't worry, you don't have to do it yourself. You can find this ratio in the bank's financial statements. Now, by regulation, they need to have a CET1 ratio of at least 4.5%. 4.5%, but personally, I only buy banks with a ratio of over 10% minimum. At the same time, you want to ensure that the bank that you buy has a liquidity coverage ratio of 100% or more. What's liquidity coverage ratio? Again, it sounds really technical, but bear with me. It's basically taking the highest quality liquid assets that the bank has, which means the assets it can convert to cash easily, and dividing it by the total net amount of cash flow over the last 30 days. That means the bank has to find out over 30 days how much cash do people withdraw if there's a bank run. And they need to have enough liquid assets to make sure that if everyone wants their money back in 30 days, they can give that money back. So this ratio kind of like ensures that they can meet those short-term obligations. So we want to have a ratio of at least 100% or more. Now you can see that for the first ratio, all the banks in this list pass with flying colors. There's the Common Equity Tier 1 ratio. Again, we're looking for more than 10%. Check this out. Even Silicon Valley Bank is 12%. Looks very safe, right? DBS 14%, very safe. OCBC 15%, very safe. UOB 13%, very safe, way above 10%. Even Credit Suisse looks safe. Credit Suisse is 14%. CET1 ratio, it's really safe. How could it collapse? Because it fails other criteria we'll come to in a while. JP Morgan 13.2%, Bank of America 11%. So they all pass that first ratio. But how about the second ratio, the liquidity coverage ratio? So we want it to be above 100%, right? And you can see all of them, again, pass that criteria. DBS 140%, 152, 140, 144. Even Credit Suisse, 144% liquidity coverage ratio. So what's the problem? Why did it collapse? We'll come to that in a while, right? JP Morgan, 169, and Bank of America, 120. Now, the problem is that Silicon Valley Bank and the regional banks are not required by US law to pass this liquidity coverage ratio, because in the US, only the big banks are subjected to this ratio requirement. And that's why the regional banks and the smaller banks are a lot more risky. So my suggestion is if you want to buy a bank, ensure they pass the liquidity coverage ratio of more than 100%. How do you calculate this? It is found in the financial statement of the banks. You don't have to calculate it yourself. Okay, let's move on to the second group of risks, which is the market risk, and included in that would be interest rate risk. So what's market risk? Market risk is when banks take your deposit, they lend it out, but part of that money they will invest into stock or bonds. And for example, if interest rates go up the way they have, what happens to the bond portfolio? The bond portfolio falls in value. And that is what happened to Silicon Valley Bank. They were forced to sell their bond portfolio at huge losses, and that wiped out their equity because of the market risk and the interest rate risk that they did not manage properly. So how do we ensure that the bank that we invest in doesn't suffer that same fate? So there are two ratios that we need to look at. The first is to look at the bank's ratio of securities to assets. So what does this mean? This means that out of all the assets that the bank has from their depositors, they will take a percentage of it to buy bonds. Bonds are a form of securities. Now, do we want them to buy a lot of bonds and to use it to invest in a lot of stock? No, because then they are subjected to a lot of market risk. if the bond prices fall or the stock prices fall, they will suffer a lot of unrealized losses. So we want the ratio of the securities or the bonds to not be too high. Now you may say, what is too high? Well, ideally, we want it to be less than 40%. Now, in the case of Silicon Valley Bank, you can see what was their problem. Their ratio of securities to assets was too high. You can see over here, securities as a percentage of assets was 56.7%. So a lot of the money they took from depositors, instead of loaning it out, they bought a lot of securities, bonds. And so they were subjected to a lot of market risk. When interest rates went up, their bonds suffered huge losses. And that's what killed them. So we don't want this figure to be too high. The lower, the better. So for example, look at DBS, looks pretty safe, only 18%. OCBC, only 12%. UOB, only 14%. So I feel a lot safer holding Singapore banks because they've got a very low securities to assets ratio. So they're not subjected to this interest rate and market risk. How about Credit Suisse? Now, Credit Suisse also looks okay on this ratio. It's only 20%, right? JP Morgan, 23%. Bank of America, 37%. So they all pass, except SVB was a bit too high, and that could have been a red flag to avoid the stock. Yeah. Now, the second ratio we look at is the loan to deposit ratio. So what does it mean? It means that for every $100 of deposits, how much does the bank loan out? Now, again, by law, the bank can loan out up to 90% of their deposits. So out of $100 they collect from depositors, they can loan out $90. All right, so the max is $90. Now, again, if they go beyond that, then it's very risky because they are going beyond that legal ratio, if you will. Now, you also don't want them to lend out too little, because if they lend out only less than half of the deposits, then they are not making full use of their deposits to lend out, right? And it's sitting there idle cash, or they use it to buy securities, and then they get into market risk as well. So you want it to be between 50 to 90%, not too high and not too low, all right? So let's take a look at our banks. How do they measure up on that ratio? So you can see that loan to deposit ratio, SVB was 43%. So again, that is relatively very low, and that's their problem. They couldn't lend out a lot of their deposits, so they put into bonds, and that's how they got screwed. Okay. Now DBS 79%, very nice, very nice. OCBC 83%, very nice. UOB 86%, very nice. Credit Suisse, ooh, dangerous, right? Look at Credit Suisse, 109%. Okay, that's a bit too high. So that was a bit of a red flag. JP Morgan 50%, okay. Bank of America 54%, okay. Right? So you can look at all these ratios. That's really important. The third risk would be credit or default risk. So this is a risk when banks lend out and people don't pay them back. Now, in the financial crisis of 2008, that was a problem. And in other bank crises, all right? But for this particular crisis, this is not the problem. A lot of the loans are high quality loans and people are paying them back. So this is really not an issue for all the banks in this situation. So one ratio we look at is called the non-performing loan ratio. Now, what's a non-performing loan? It's when a bank lends, makes loans, and people don't pay back within 90 days. In 90 days, they don't get any interest back. It's called a non-performing loan. And if you divide that by all the loans, that's called the non-performing loan ratio, which means out of all the loans, how many of them are in trouble of being bad debt? Okay, and you may say, what's a good figure? Well, the lower the better. And you can see that for all the banks, their NPL ratio is okay, right? Even Silicon Valley Bank, only 0.2% non-performing loan ratio. DBS 1.1, OCBC 1.2, they are all very low. So this is not an issue in this crisis, all right? Now, let's look at the last risk. And the last risk is something hard to quantify, but it's more of a qualitative risk, which is the reputation of the bank. Now, because banks are so highly leveraged, you can understand that for a bank, the most important thing why people put their money there is because of reputation. You trust the bank. The moment a bank loses that reputation, it's over. It doesn't care. It doesn't matter how great their ratios are. Like Credit Suisse have really great ratios, as you saw, but the moment they lose that reputation, everything else doesn't matter. So that is what caused the collapse of Credit Suisse. Now, did it happen overnight? No. If you have been following Credit Suisse for the last 10 years, they have gone through a decade of reputational damage. Let's review all the problems of the last 10 years. First, in 2011, they were fined $2 billion for helping US clients evade taxes. Okay, and then in 2012, they were probed for the LIBOR manipulation, which is manipulating interest rates. Bastards. Okay, and then in 2014, they were they paid a fine of $154 million to settle the dark pool share trading venue, which is some shady shit they were doing, right? And then in 2016, they were guilty of wire fraud because of the Mozambique bonds, called the tuna bond scandal. All right. Then 2016, they were fined for helping 1MDB launder money. And then in 2018, they had this scandal where they spied on their own managers, the bastards. Okay, they did it twice as well, and they had a $3 billion loss from the Greensill Fund, where they were kind of like sued for mismanagement. And in 2021, they lost $5 billion from the Archegos fund scandal. If you guys remember, Archegos by Bill Huang, his hedge fund collapsed, and Credit Suisse lent him a lot of money, and he was a very shady character, which they didn't care. They lent him anyway, and they lost a lot of money. And then most recently, in last year, they were guilty for helping the Bulgarian mafia launder cocaine money, right? So if you look at Credit Suisse, I mean, it's not overnight. For the last 10 years, they've been acting like a bunch of freaking criminals. So people who bought stock in Credit Suisse, who bought the bonds and lost money, you freaking deserve it. I mean, think about it. If you invested in Credit Suisse or bought their bonds, it's like you marrying someone when you know that for the last 10 years, they've been on a crime spree. They've been robbing the bank, they've been selling cocaine, they've been molesting kids, and you go marry them. Of course, you deserve to lose money, right? So reputation is really, really important in the banking industry. So in summary, personally, I would only buy the highest quality bank stocks. In the US, I would only buy JP Morgan, Bank of America, and for example, Morgan Stanley. Now, I only want to buy bank stocks when they are significantly undervalued, because if I buy them at fair value, it's not worth it, because once again, they've got low growth and they're very cyclical. So the question is, how do I know when it's undervalued? How do I know it's cheap enough? So the way to value bank stocks is to look at the price to book ratio. So what I do is I look at the last 10 years and take the average price to book ratio, and that would be the fair value for the bank stock. So for example, look at Bank of America, and you can see over here, I've plotted the 10-year price to book ratio. And if you take the average of 10 years, it is 1.04 price to book ratio. So if you take 1.04, multiply by the book value per share, that gives us a fair value of, tada, $32. So in other words, for Bank of America, the fair price, the intrinsic value is $32. So currently, Bank of America is selling at $27. It is below the fair value. Will I buy it? No. Not good enough for me. So for me, I will only buy it if it goes at least one standard deviation below the fair value. So I get a good enough discount. So what is one standard deviation below the fair value? It comes up to 24.72. So for Bank of America, I'm only interested to buy if it goes to 24.72 or below. That tells me that historically I'm getting an undervalued level, and that would also be below a price to book ratio of 1. So historically, I've bought Bank of America only when it's been at those levels and I've made a lot of money from it, and I've sold it. I have not held on to Bank of America for the long run, because for banks, it's not something I hold for the long run, except for Singapore banks, because they pay a very good tax-free dividend, and that's another story. Now let's look at another US bank, JP Morgan, and let's see if it's cheap enough to buy, in my opinion. All right, so for JP Morgan, the same thing. If you look at the last 10 years, their average price to book ratio is 1.45. That's the average for 10 years. So if you multiply 1.45 times the book value per share today, that gives you a fair price, fair intrinsic value of $131. Okay, so currently JP Morgan is selling at 125. It is slightly below the fair value. To me, is it a buy? No, it is not cheap enough. Again, I'll only want to buy if it's one standard deviation below the mean, and that would be at a price of 105. So 105 is the price to buy at. That I feel it is cheap enough for a position, right? So you can see it actually hit that for a while and then it bounced back up. Okay, so generally that's how I value banks. Let me show you one Singapore example, shall we? Singapore bank example. Now, Singapore banks, let me make a disclaimer. I've got a big position in all three Singapore banks. I bought them when they were very cheap. In fact, I've got over $1 million just in the three Singapore banks, and I buy them purely to collect dividends because they're giving good dividends of close to 5% tax-free. Now, I already bought the banks long time ago, but would I buy more shares right now of, say, DBS Bank? The answer is, let's take a look. Let's look at DBS Bank and I'll show you whether I think that it's worth to add more right now. And the answer is no. Okay, why? Because again, same thing. If you look at the last 10 years, the average price to book ratio for DBS is 1.29. Right now it's above the average. If you take 1.29 price to book times the current book value, it gives you a fair intrinsic value of 27.28. That's the fair value, right? And currently DBS is selling at 32.22, which is above the fair value. So to me, it's not cheap, right? It's still expensive. Although one good thing is that because they're paying such good dividends, you are getting a dividend yield of more than 5% right now, but it's still expensive on a price to book ratio level. So I look at two things. I look at an attractive dividend yield, and it should be fairly priced, ideally near the fair value. All right. Now, sometimes I may still buy above the fair value for Singapore banks because they are so safe and they give a good dividend. But if I do buy them above fair value, I never pay more than one standard deviation above that. And right now it's even above one standard deviation. So I still think that DBS, no, I won't buy more until it gets cheaper. I hope it goes lower so I can buy even more this year. Now, if you want to learn exactly how I analyze all kinds of stocks in the world, how I buy only the best companies in the world, knowing what to buy, when to buy, how many shares to buy, and when to sell, do enroll in the Value Momentum Investing course where you will learn all these strategies. If you want to follow me every day to see exactly what I'm buying and what I'm selling, where I do all the work for you, where you get my live buy and sell alerts for investments as well as options, do check out insight.piranhaprofits.com, where you can subscribe to the Ultimate Investors Playbook, where you get to watch me invest and trade live every single day. And again, if you're interested in our courses, go to piranhaprofits.com and go check out your favorite course. So may the markets be with you, and I'll see you guys soon. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.